Good afternoon, our 3 p.m. as usual. And today's topic is about reasonable compensation for S corporation business owners. A lot of our small business owners are S corp shareholders. So when you work in the S corp, when you are the boss and you want to be paid a reasonable compensation. This concept comes from the IRS not wanting you to run away from Social Security, Medicare payment. They want you to pay yourself a W-2, then you can get your distribution. But if you don't pay yourself a reasonable compensation, you got a whole bunch of distribution to go home with, which you don't pay Social Security, Medicare taxes. That's where IRS is frowned upon. They want to stop you from doing that. But we have small businesses are so special. They work so hard, but they didn't make it. So in that case, do you still want our small business owners to break the bank, pay themselves anyway because they worked hard, they deserve a lot, and but the company don't have any money. So now, this 30 minutes, I want to give you a very solid answer by pulling some relevant information from IRS website, from the places where, we authoritative place, not just google.com, and then to put it together and give you the right answer. All right, let's go ahead. Look at our communitycpa.com website. Yes, that is our website. And when you come into our website, then you will see this banner page and, with details underneath it. I just did a screenshot for you because I want you to get familiar with our On Board with Us button and appointment button. On Board with Us, you can become our client by uploading your information there. Right? And you can do it 24/7. You don't have to wait for, or if you couldn't sleep, you want to get contact with us, that's where you go. Appointment button is also a place where you make appointment with us online. So we will meet you online in the virtual world, but you know where our office are. So on our website, you will see all the locations. You obviously can go to the physical locations if we have a branch close to you. This is our YouTube channel, and if you could subscribe to our Community CPA YouTube channel, you would receive notifications while we have a useful topic coming in. We don't just randomly talk whatever we want. We actually knew how people think at a certain time. Why do we have a reasonable compensation today? Because it's year-end. While we are doing tax planning, we saw business owners are struggling with cash flow, but still thinking that they need to pay themselves $1 million. No, you don't need to when your cash flow is not there, when you are not even making it. So we want to answer John's question, right? And John actually is our client, and he always paid himself. He always know that he needs to pay himself, but his business is just having loss for the last couple years. He doesn't have money to pay himself. He doesn't have any employees. He's the only employee, and he has losses in the 6 digits. So how do you want him to pay himself reasonable pay? Although he's worth $1 million, he's probably CEO, and in Tesla, Elon Musk, annual salary goes on the billions. So really, it is not about he doesn't get a reasonable pay. It is he doesn't have it. If that's the case, do you still struggle with paying yourself a W-2, pay more taxes to IRS? The answer is no. You do not need to when you are at loss. So this is the kind of webinar that we put on YouTube channel, and you literally can do search, find them, or you can just subscribe to our channel and you hear what we have here for you. I have 2 books on internet. Hopefully next year, 2026, I can pull out the 3rd one, which is 2 p.m. I had a lot to put in that one book, but the economy is so unstable right now, it is hard to pull out a expansion plan because it is hard to expand when your economy is not at the right place. So the book itself has been dragging for 2 years already. So I hope that 2026 offers a little bit of stability. We'll see. All right. No responsibility disclaimer for the content of our webinar. You want to make sure that you do not trust information on internet. And including anything you hear right now, you got to have your own judgment. You want to know that if you're not sure, do your Google. I mean, Google is pretty good. In terms of the AI capabilities, Google is doing a pretty good job to not be left behind. When you go onto Google searching for questions, it does a pretty good job for you. Although, of course, in the professional firms like our firm or the legal law firms and people like that, Google is not our tools, right? It's our toy, but it's not our tool. Our tools are actually authoritative database where we search for code, we search for answers, and with references from IRS website, all of these, what we call authoritative resources. That's what we get our information from. All right. With that said, you can trust us a lot, but still, it is your responsibility to make sure our content is right. All right. Why the reasonable compensation under S corporation is such a big deal? Why? It is a big deal because the IRS want to make sure that when you work, you accumulate future pension. In another word, accumulate Social Security, Medicare. So when you get old, you get Social Security payment, right? And you get Medicaid, Medicare supplement, and from the government programs. So all of that, getting old tools, those are safety net. Not to say you have to rely on Social Security, but Social Security payments still can be used for buying some, cute things for yourself. Even though you are wealthy, you don't rely on that. But it is a lot of people's safety net. So the IRS want to make sure that while you are working, you contribute to that tax, which is Social Security, Medicare. Then the IRS also want to make sure that as a S corporation, IRS know that if you made money, it's going to go to your K-1, and you bring your K-1 to your 1040, and your 1040 don't calculate Social Security, Medicare taxes. So they know that your distribution walk away from about 15% taxes. So the IRS want to make sure that you are fair to yourself. You're not putting everything in distribution and not putting anything in the payroll, right? And also, when you have payroll, then you can run more deferred benefit for yourself, like 401k solo and 401k profit sharing, SEP plan, IRA, all of these things is calculated based on the salaries that you pay to yourself. So with that said, that gives you the reason why this is even a thing, because the IRS want you to have a pension from the government standpoint, then the IRS want you to have your own salary benefit resulted from the deferred retirement. So all of that will give a reason why this thing matters, right? All right. So then, what is the reasonable compensation? Of course, to really search for reasonable compensation, you can go onto DOL website to search for prevailing wages. You can just go on DOL website based on your region where you at, give the title, and you find something over there. They give you a salary range saying, this is the market rate. That's what they say. So in the simple terms, IRS expects you to pay yourself the market rate. So let's say if I am an accountant, if I just search Midwest accounting with 3 years experience, what is my salary? The website actually gave me a prevailing wages from $40,000 all the way to $65,000. So that is the range what we call reasonable. If you pay yourself $45,000, you're good. And you are within the reasonable compensation. But again, you hear what I'm saying here. When you are organizing your payroll, you also are considering your distribution. So your payroll, what you pay to yourself, and your distribution, what you take home, these two numbers need to be constantly measured. You don't want to have a big loss, then here you still run your own payroll. That is just not even logical for any business. It's almost like you're losing money, but you still pay someone a big salary. In reality, what's going to happen? If that person is not you, you're losing money, you probably let that person go already, because you can't afford to have your business in the red, then you can continue running that way. You want to, of course, the distribution is calculated at the very end of the year. So your salary, your expense, everything is already paid. So you want to make sure that when you determine the reasonable compensation, you want to determine based on the history of last year and based on the understanding of the current year. Come up with that number, then have your payroll people running it from January to December. We are into 2026, right? So you need to look at your own reasonable compensation. The common misconception for reasonable compensation, I put 3 of them here. So one of the misconceptions says that I can take only distribution, I can take distributions to avoid payroll taxes. That is a wrong statement. You cannot. The IRS requires a salary if you are going to write yourself a check for distribution. Any salary amount is acceptable as long as I pay myself. That's wrong. And we have a very famous case for actually in Iowa. There is an accounting firm some years ago. They have their partners in the accounting firm. Their distribution was $250,000 for 4 of the partners, but their salary they're paying themselves was $24,000. So that's what they're doing. They're paying a very minimal salary, whatever the amount they have, then they put all of the money into distribution to not pay Social Security, Medicare. See, that is wrong. So they got investigated by IRS, audited by IRS, then they went out to the court to debate. So the final is that they still have to pay themselves $60,000 on the salary, then the rest can be distribution. So they ended up paying taxes as a penalty. Interest and a penalty on the payroll tax side of things. Then they have to amend their tax returns for 3 years, right? So that's kind of the story on that. So you got to pay a reasonable salary. Not any salary amount would be acceptable. It's not true. This doesn't apply to small business. Of course, it applies to small business. It doesn't matter how small you are. If you are S corporation, it applies to you. That's why John comes, because he is not making money, but he is burdened by the $50,000 salary he has to pay himself every year. So he's coming to us, goes, what do I do? And I have a reasonable pay I have to do, but I really don't have money. I already didn't cash the money that I paid myself last year, Ying, and I couldn't afford the reasonable pay. So the answer to John is that you should never even do a reasonable pay because you don't have a profit. You are still in the startup phase and you're still trying to survive, and your whole distribution is negative, is not positive. You are putting in your money to run the business, you are not getting it out. So you should not even run a reasonable compensation. So that would be the answer for John. So what IRS look at in this case, when they claim that you should have a reasonable compensation, your compensation is not reasonable, what they're looking at is the duty performed, the time you put in the business, the training skills, experiences that you acquires that position to have, and also the industry average, like prevailing wages, right? Or your company size and your condition of the company. They're looking at all of these to decide on that. So there's three approach IRS typically do for reasonable compensation. They look at the market approach. They look at replacement cost, like what if you die? If you die, the company folds. They do look at that too. So they look at the replacement cost approach to see if you're not here, you hire a new CEO, how does that work? Then, of course, income-based approach, which is what I was talking about. If your income is negative, and this approach can lead you to the place where you do not need to get a compensation. Okay? So, of course, the IRS always say that the income-based approach is sort of like a supplemental approach. They don't use that as the only one approach to decide like how much money you should pay yourself. So here I have 3 slides to go into detail to talk about these 3 approaches. So market-based approach is to identify job title so they can match your duty, and they use external wage data sources like DOL data, adjust to the region. Depends on where you are, and your rate can be very different. From Iowa to California, it is about 15% of difference. So if you make if you make gross salary of $10 in Iowa, 15%, that you at least should be $11.50 in California. So there is a market difference, so that you need to be aware of. Replacement cost is also linked with what you perform, what kind of tasks you do, right? Because that related to the person who come in to do that job, and you got to pay for what they do. So that's kind of important. And then the last one, the income approach, is looking at the salary assessed as a percentage of the profit. If you don't have a profit, percentage of profit is what? 0, right? So this income-based approach is not a singular approach. You have to combine other ways to think of. I know I give you these ideas, and you're going to be like, Ying, forget it. If I really going to determine reasonable pays, I just sit in your office and you tell me. Of course, that can be done. Of course, that's what our job is, right? Our job is to give you our experience and our opinions. And with our opinions, and you can go to file your tax return without worry, because we have pretty good track record in terms of working with IRS on people's reasonable pay. So we know how to work it out. And there's one example here I give you, says that S corporation has a net income of $180,000. The owner take a $24,000 of salary, but the owner takes distribution for $120,000. The owner is a full-time worker there. The fair market value according to DOL, the owner should be paid $80,000 to $100,000. So the IRS would come to make adjustment. So then they reclassified that to $66,000. This is actually the case I was talking about that happened in Iowa. So the IRS originally was asking for $100,000. Then they went to tax court. So the tax court lowered that to $66,000, but it's still greater than $24,000 they were originally paying themselves. The problem is not about the $24,000 they pay themselves. The problem is that the distribution is too big. The distribution is $120,000. Then you only pay yourself $24,000 on salary. That makes the difference. All right. Then the other example I have here is brand new business with a low cash flow, right? So first year revenue, $120,000, expenses $90,000, net income before salary is $30,000. Then the reasonable pay on DOL website is $65,000. Are you going to do $65,000? Of course not, right? And you want to just go with your income. $30,000. So your salary in this case need to be bigger than the distribution. So that's where, when we do tax plannings for our for business owners, this is where we have flexibilities. We will lower your income, or we'll lower your salary, or we increase your salary, depends on the business. So this is very important, a very important thought that you should have in your mind. So this reasonable pay is not a fixed thing, right? John don't have to run $50,000 W-2 payroll on him, rain or shine, and he's still digging a hole for himself now. He's still paying himself. Very crazy. So you know that is flexible. Now, so how distribution fit in? Salary must be paid first. Distribution is supplemental income, should be coming after the salary and the payroll taxes. Make sure that to take distribution without paying enough salary would trigger IRS's red flag. So you want to make sure that you avoid that. But you may say that, oh, Ying, that's just not fair because I have like 10 employees and, I take bigger distribution because my employees are employees, they don't take distribution. In that case, your distribution is not like you are by yourself. When you have multiple people working in the company, your distribution for your part of distribution, it should be divided by the people who work in the company. So you only have 1/10 of distribution. That 1/10 of distribution should not be bigger than the salary you're paying yourself. Make sense? That is kind of how you look at that. All right. So when salary can be lower, many times, many reasons. Startup, early stage business, salary can be lower. The owner works part-time, salary can be lower. Seasonal businesses, salary can be lower, right? Or you just are not even working in your business and it's your employee who works there. Your salary can be lower. You will say that, okay, I got it. If I don't have income, if I don't have gain, I don't have profit, I don't have salary. But if I have too much profit, how do I measure my salary? How do I bring that up? So the owner need to look at the year-end result to adjust salary every year to make sure that it reflects the picture of your business, right? So this is kind of the conditions of how should we raise salary. And the best practice for 2025, right now, we are at the right time to rethink of reasonable pay, okay? You may be the candidate to get rid of the payroll, and you may be the candidate to add a payroll. You may be the candidate to increase your payroll because you did well this year, okay? Make sure that you recalculate your salary and use the tool that we give you to properly come up with the decision of your payroll. If you can show IRS the decision you made at the end of the year for what payroll you're going to run next year, that would be the best defense you have for IRS to come around barking their orders and telling you how much you need to pay yourself. You don't have to be subordinate like that. You don't have to, just listen to what they say you follow. You have your own documentation and you can definitely bargain for your decision because, right now, whatever the agency decision they made, you can challenge. And that, I forgot whether that was a Supreme Court decision or it was, I think it's a Supreme Court decision to say that the interpretation of IRS regulation, it is not the agency don't have the final say. That's what the Supreme Court decided already. So it is up to the professionals, people like us, to debate on the reasonable pay and using reasonable logic, right? All right. So with that said, my last slides would be that takeaway. Okay? Make sure that you know your reasonable pay can be adjusted. Don't think it is set in stone. That is really the key I want you to take home. The second key I want you to take home is that if your business is at loss, you don't have to pay yourself anything. You really don't deserve it because you are running at loss. You don't deserve a pay. You are the business owner, so you can work for free. Nobody else can, but you can. So that is a key for you to remember. And of course, if you come to me, you come to Ying, goes, oh yeah, I want you to decide what is my reasonable pay. Then I need your financial data. I need to know what you are doing at your office. So all of these approaches we talked about, right? The market, the replacement, and the income, the three approaches, and we took it into one, and we decide one for you. So that's how we are doing, which is also the IRS, guidance to provide to the professionals. All right, we are wrapping it up. And here is our, on our YouTube channel, no, on our website, when you go to the appointment button, and you will see the partners. These are partners at Community CPA. And the one in yellow dress, that's me, just in case you don't recognize me anymore, because I know people changes. So you can book our time. You can go in, and I know one of the partner has a free consultation. You can always start with the free one if you don't want to spend your money yet, but nobody ever, and I have these kind of appointment literally daily, and nobody ever would ever complain I did not give the answer. So I'm the answer book. All right? I am proud to announce I am the solution. All right. So last slide, but not the least, folks, you see our website, you see Catherine at communitycpa.com. She is our librarian, she's our marketing manager. She really does care about the input you give to us. So make sure when you watch our videos, leave comments. When you want us to talk about something that we have not touched on, send us an email, send Catherine an email, demand that to happen, and we will beef up the knowledge and come to talk to you. And here is our phone number, 515-288-3188. This is our 30 years old number, so you can call us, and all of our branches will ring when you call this number. Somebody, not robot, some human will pick up the phone. And that is our promise to you. In this day and age, and robot is so much everywhere, but we're not robot. And, the only reason we say we're not robot is because we give ourselves a chance to be able to show the human side, mistakes, emotions, frustrations, appreciations, name it, right? So we have that for you. And remember, our office open from Monday to Saturday, 6 days a week, 8:30 to 5:30. And I will see you again on Saturday. Oh, this Saturday, I'm actually not available. So it is another partner. He will talk about, I forgot what he will talk about, but Dan will be on the webinar and you will see our notice. I will see you again, okay? Bye-bye.